can call the meeting to order, we just can't approve the minutes or
That's
do any of
correct.
that other that
And you
stuff.
certainly, Madam Chair, you are recorded, so you have it for posterity for all involved to get up to speed before your next meeting. So to the extent that there's information provided, everyone will have the benefit of that information.
Right. And we'll give it like one more minute. One over there. Kentucky Derby. It was fun. Of course, we didn't, our trifectas.
I think so.
Okay.
Just want to make sure any hard questions are coming in. This way.
All right, well, let's go ahead and call the meeting to order then. Can you go ahead, Ms. Mosier, and do the roll call, please?
Certainly. Sue Burton,
Here.
David Harrington,
Here.
Matthew Crutcher, Landon Moore, Mark Munson, Laura Bellin,
Present.
Gary Waters, Derek Challenger,
Present.
Solomon Ashby,
Here.
Elizabeth Gooden,
Present.
Ann Seward. We have many out, and you do not yet have a quorum.
All right, thank you very much. So just for everybody have a chance to read the minutes, and we can't approve it until next month unless we get a quorum that walks in, but let's go ahead. Were there any applications for retirement?
I did not receive anything.
Okay. And you want,
There's no changes in any of the numbers. There's still 19 in fire and police and 17 in supplemental.
and no deceased?
Not that was reported.
Okay. All right, on to the recurring business reports, the schedule of historic funds flows report.
As of the end of March year-to-date, we had a beginning balance of $230,630,954.83. Your interest income, year-to-date again, $4,359,709.28. Administrative expenses, $161,391.15. Your return of benefit payments, $47,979.65. Your recurring benefit payments, $22,904,333.09. Your employer contributions, $4,158,377.51. Your realized gain, $1,773,072.34. Your unrealized gain, $4,790,304.96. You have seen a net loss year-to-date of $7,936,280.50. Your ending balance is $222,694,674.33. This is a change from this point in time of last year. We are down $8,259,189.74.
Copy.
Any questions? Thank you very much. All right, the OPEB trust status.
It's the OPEB. I included what I could get off of the website. It's not a statement, it's just a summary as of May 4th, but I did want everybody to see that we have transferred the $3 million into it. That went just before the end of April.
The other thing is,
Madam Chair?
the other thing is that the documents that were signed by the board the last meeting were transferred to the company We've received the executed documents, and so that part is done as well.
All right, very good, thank you. All right, we have unfinished business. We have an investment committee, RFP status report.
All these scores are due today from the members of the panel. So far, I've received 2, and I'm waiting for the rest of them to come in. And once we get those, we'll do the tabulation and narrow it down to a minimum of 2 companies to interview.
All right, thank you very much. On to new business, we have an invoice or 2 to approve from John Hancock, and we can't do that right this minute. So if somebody walks in, we'll do our very best, Tom. So you can get paid.
We know no one's going anywhere, so.
That's right.
Show me on this. All we need is police to respond for a one
So
vehicle
unless
accident.
anybody has any other business to attend to, I think we can move on to our quarterly investment review.
Madam Chair,
Yes.
I just want to make one announcement. I'm not sure if it was made before. I was telling the chairwoman that I think I'm in so many meetings, I think everybody knows. But the city manager did select a new CFO. Cheryl Spivey will be starting on May 21st.
Do we know where she came from? And
Yeah, she came from the city of Fayetteville in North Carolina. She has about, I think about 30 years of, financial experience to include debt management, accounts payable, all the things. I really believe that I think debt management was her expertise, her area of expertise. She comes very well recommended. I think pension, risk management, I think the city will be pleased.
And she starts May 21st?
May 21st.
So she will be able to be here at the June meeting?
That is correct.
And you said it was Cheryl Spivey?
S-P-I-V as in Victor, E-Y.
Okay.
And I
Great.
did hear yesterday she and her husband have moved and bought a house here in Portsmouth.
All right. Very good. All right, now we can move on to Brian and our investment report. Thank you. See you later.
Okay.
Well, great. Thank you very much. And we're delighted to be here with you again today. We're going to talk about first quarter results, and we'll start, as we always do, with sort of an overview of the capital markets and what our outlook is for the remainder of the year. But maybe before we even get started, you probably see somebody sitting between Jim and I that you don't necessarily recognize. Jeff McConnell is the Chief Investment Officer for Greystone Consulting. He's based out in New York. And we thought it was a good opportunity to bring Jeff in to introduce you to him so that you can see that there's more than Jim and I that are charged with looking at your investment program and the advice that we develop. So Jeff is going to talk about how we look at investment managers, how we evaluate them, and he'll talk about a lot of the resources that he has behind him as well. So we wanted to just bring a new face and introduce you to him so that you understand it's not just us.
Morning, everyone.
But with that, I'm going to turn it over to Jim, and we'll get started on a review of the capital markets.
Good morning, everybody. It's always a pleasure to be with you all. Certainly to be in a warmer climate than Chicago, which just bypassed spring completely. We're going to start with the thicker book, tab 1. I'm going to spend just a few minutes reviewing the first quarter capital market performance. And spend a little bit more time on our economic slides. So I'm going to ask you to just turn to slide 4 for a moment. And what started out as a really terrific year, the global markets hit a speed bump in the first quarter as volatility returned. There were concerns about inflation, geopolitical matters, and monetary policy, higher interest rates. And all of that caused some pressure on the markets during the first quarter. And we actually had our first 10% correction since 2015. We're going to look at some numbers that are slightly down for the year across the board, whether it's international markets or U.S. markets. But I think those numbers really mask what happened during the quarter. So we're going to spend a few minutes talking about what happened. And we're also going to talk about how we took advantage of that volatility for the benefit of Portsmouth. So U.S. equities were up a little over 7.5%. At one point during the year, they were down 3.46 at the lows, and that is, of course, a little over a 10% correction. Tech sector led the performance this year, up about 7.5%. Consumer staples, on the other hand, were down about a like amount. And that's important because those are the type of stocks that one of our managers, Schaefer Cohen Premium Dividend, tends to have a higher degree of exposure to. So a little bit of a rough quarter. Brian will go into that in some detail. So let's just turn the slide to page 5 and look at the numbers. And these are the U.S. indices for the quarter. And you can see what I was saying here. We had a 10% correction, but if you look at the actual numbers, S&P 500 down fractionally 0.76, Dow Jones down almost 2%. In the quarter, if we're looking at large cap, the other thing that suffered was value, was down 2.83% versus large cap growth, which was up a little over a percent, almost 1.5% for the quarter. If we turn to slide 6, very similar results for the foreign indices, MSCI, EFA index, global non-US, down 1.4%, Europe down 1.8%, and we see that measured up against the S&P 500, which we reviewed, down 0.76. Slight winner for the quarter was emerging markets, up 1.47%. If I can draw your attention then to slide 7, we could look at the fixed income side. Interest rates increased during the quarter. The 10-year U.S. Treasury increased to 2.74%. That was up from 2.41%. So that's about a 13.7% change for the quarter. So that's what happens when rates are close to all-time lows and we see moves up. The percentage change is pretty powerful. So if we look at the quarter, the broad aggregate index, which is the one we use for fixed income as one of our benchmarks, down 1.46. And then, of course, the longer dated bonds were down 3.5. So let's spend more time looking at the economy. I think the market was really that 10% correction that we hadn't seen in a while. That was really the highlight for the quarter. So I'll have you turn to slide 2, tab 2. So to start with, this 2018 is a much different year for us in terms of our forecast relative to 2017, which just to reflect on for a moment was double-digit equity returns around the world. That was our call at the beginning of the year. We saw some volatility during the course of the year, but as the year progressed, we actually did see double-digit returns in most of the equity markets around the world. Much different perspective for 2018. The concerns we have for 2018 relate to inflation. We think the market's starting to price in higher inflation. It's still very early. That's being reflected in higher interest rates. And just yesterday, that 10-year Treasury, we looked at it at the beginning of at the end of the quarter, it was at 2.74. That's now at 3%. So rates continue to tick up. We expect them to go higher during the course of the year, and then tail off towards the end of the year. So that's certainly causing investors some anxiety. I think the other points that investors are starting to focus on is we're very long into the business cycle, and investors are starting to attempt to discount what is the peak in earnings for the cycle and what is the peak in the economy. So when you overlay all of that, that means quite muted returns this year. It's a lot to digest. in any year for investors, but we still think the returns will be positive, certainly for the U.S. and Europe. So because it's a much more dynamic year, a year of transition, we've created this checklist that you'll see on slide 3 to measure the progress that we are forecasting for the year. And as you can see, we think we're actually surprised at how well along we are with some of these changes. And that's where you see the big red check mark, contracting PE multiples on stock, the price investors are willing to pay for earnings. We are forecasting higher interest rates and higher foreign exchange volatility, which will cause us to have higher equity volatility. Check that box. Narrowing breadth, so fewer stocks moving up over time. We've seen that. Credit spreads starting to widen from all-time lows, starting to see that. And then the next 3 have smaller check marks because we're just starting to see changes. So we think it's worthy of a check mark, but there's more to come. And then throughout the course of the year, we think the bottom 3 boxes will be checked as well, and that's falling incremental operating margins, higher earnings dispersion estimates. The good companies will do well, and the weaker companies will do more poorly, and that will start to be more apparent during the course of the year. And then finally, and we could probably put a very small check at this more defensive leadership, and that is that the stocks, the sectors or industries that did really well in the last year or two, particularly technology, starts to rotate into more defensive names. And we'll look at some charts to tell you that we've actually seen a little bit of that since the peak in stock prices this year. Next 2 slides are probably the most important slides in the book. On slide 4, what we're looking at here is the forward earnings estimate for the S&P 500. And this slide illustrates how the market peaked with the tax bill. And the first peak came when the taxes were cut, but then we had a second high as investors digested the order of magnitude of these changes. So you can see this spike prior to the tax cut. Earnings estimates for the market were about $145. Post-tax increase was $161. So tax cut had a very powerful effect in terms of profitability for S&P 500 companies. Certainly had an effect for small and mid-cap companies too, but we're looking at just the larger capitalization companies. So that's always good when earnings are going up for the broad market. And then what we're seeing at the slide just below that is a corresponding PE ratio, and we saw that PE ratio collapse. And remember, when we're looking to buy equities around the world, we want to buy them more cheaply with a lower PE. And so by definition, when earnings are going up and prices came down as well, what we're looking at on slide 5 is that prior to the tax cut, the multiple on the market was about 18 times. So by historical standards, a little bit rich, a little above average. Post-tax cut, because of the higher profitability, and by the way, earnings look like they're going to be up about 23% compared to the first quarter last year at this point. So the consensus was about 18%. A few more companies trickling earnings at this point. The majority of companies have reported, but 23% increase in first quarter earnings. Pretty powerful. So that caused a collapse in the PE. And what did we do when we saw this PE move back down to about 16.5 times? Well, this is when we decided it was, I think it was about March 23rd that we made the trade. We took $11 million out of Schaefer Cohen Premium Dividend, which is a more defensive manager, and we used this pullback in both equity prices and increased earnings to move $11 million out of Schaefer Cohen Premium Dividend and into the S&P 500 index, which is something we've been migrating towards for almost a year now. And that's worked well for us. Brian will review that. The reason I mention that to you is it's really because of these tools and resources that we have available to us that allow us to make these decisions. I think it's pretty easy to find somebody to shepherd your asset allocation and just tell you each quarter how the market has performed, and correspondingly, this is how your portfolio performed. But, and Brian and I have emphasized this repeatedly at these meetings, it's because we have Morgan Stanley capital market expertise supporting us at Greystone is what makes us aware of the fact that we've had this collapse in PE, and we, as a result of that, we look across our clients and say, what should we be doing now? And that's a huge distinction for us between our competitors who just don't have that capital market expertise to make those recommendations and shifts at the right time. So we could be wrong. Market could sell off for the rest of the year, but we think our competitive intelligence says, and by the way, that low point where we see the first precipitous drop, March 25th, that's exactly where we made the move.
Sometimes it's better to be lucky than good.
Like, as I said, we could be wrong, but we want to use the information and intelligence we have to make the most money we can for Portsmouth. We get a lot of questions about Bitcoin. So what we thought we'd just include one slide just to share with you our thoughts about Bitcoin. And what we see here is, and I find it actually pretty fascinating and interesting, is that when PE multiples peaked, which we looked at when the Senate passed the bill, that was almost the exact time that Bitcoin price started to collapse. And so one of the ways that we think about Bitcoin in this current environment that we are in is it is the animal spirits of risk. And when investors feel like taking risk, Bitcoin prices go up. When PE multiples peaked and started to decline, guess what happened? Those animal spirits said, too risky, start to sell, and you see this very precipitous decline in Bitcoin prices.
I saw what Warren Buffett had to say about Bitcoin the other day.
No surprise. by a cryptocurrency that's not backed by a central bank. The next slide, it relates to one of the checklist points that I talked about earlier that we're monitoring this year, and that is a change in leadership. So I can draw your attention to the left-hand side, you can see the performance of technology, financial, discretionary industrials for the last 12 months. So we refer to these as cyclical or momentum sectors that do really well when the economy is strong. And the economy has been picking up strength, so it's not a surprise that these sectors have done well. But if I can slide your attention to the right for a moment, you can see since 1/26/18, that's the actual date that the S&P 500 peaked this year. And then since 3/13/18, that's the date that the NASDAQ peaked. You can see that we're starting to see a rotation. Looking at the far right, since the NASDAQ peaked on 3/13, what are the best performing sectors? Utilities, energy, real estate. Those are things that do well when the economy starts to weaken. So our view is that this is very slow, it's very gradual. These numbers are not indicative of a trend yet, but we do start to see a shift in the leadership in the market. This next slide, on slide 18, is a slide. It's very simple, very straightforward slide. It demonstrates international market performance versus U.S. equity market performance. And very simply, when the line is going up, international markets are outperforming. When the line is going down, U.S. markets are outperforming. So you can see that we've had, from 2008 to 2016, we had a massive outperformance of U.S. stocks over international stocks. And then just last year, we saw a slight turn up where non-U.S. stocks, European stocks in particular, started to do better than the U.S. And it's our view that these cycles, as you can see from the slide, persist for some time. And so while it's very fashionable to have big positions and overweightings in U.S. stocks, it's our view that we want to start shifting money out of what worked really well into what hasn't worked. And over time, if we're going to make money, we might be a little bit early, but that's one way we can help grow, grow the size of the portfolio, is investing in spaces that are a bit out of favor, and certainly international stocks, Europe in particular is. And so we have a slide. It's great to talk about it, but what have we done about it? So since we've been involved in the portfolio, we've moved about $42 million into international stocks. So it's not an insignificant change, and we've made an adjustment in the portfolio to reflect our views. And we have, as I said, we may be a little bit early, but we think over the cycle that should work well for us. The last slide I'm going to talk about is interest rates. It's really front and center. I think you can't pick up a financial publication without some article regarding interest rates, and particularly the 10-year Treasury, which is the most global recognized index in the world from an interest rate standpoint. And what you see in this slide on page 9 is this long channel going back to 1986. And it's pretty straightforward. It's within the channel. It's been a fantastic place for investors to be, having exposure to fixed income. So it's market interest rates move up a little bit, but then we see lower lows. Interest rates move up a little bit, then we see lower lows. And we've been in this channel, but now we're approaching the top end of the channel. So something changed here, in our view, this year. And there's a great debate about whether the 10-year Treasury will break out of this long-term channel. In our view is that, yes, we will. And it's because the era of quantitative easing from central banks around the world, but in the U.S. in particular, and fiscal austerity are over. And a lot of that is what drove this, particularly in most recent years. So we don't think it's going to be a draconian breakout, but we do think over time interest rates will start to move up. And Brian will touch upon this today, and we're thinking at our next investment committee meeting, we'll do a fairly detailed discussion about how your fixed income portfolio is invested. And if rates rise, what does that mean for the portfolio? So we have the tools and resources to shock the portfolio so that we can demonstrate to you what happens if and when rates go up by another 0.5% or percent, or even worse. And we think that we've generally protected the portfolio, at least part of the portfolio, against those rate rises, and Brian will cover that in a minute. So those are our views. Anybody have any questions about any of the material I covered? Happy to take your questions. No. Thank you very much for your time. Appreciate it.
Jeff, do you want to talk about manager stuff, and then I'll get into the overall portfolio and relate a lot of what was going on to some of the comments Jim made. But I think now is probably a good time to have Jeff talk a little bit about the separate handout that I passed around.
Yeah, thanks, Brian. So yeah, thanks everyone. Thanks for having me. As Brian said, I'm the Chief Investment Officer of Greystone Consulting, which of course Brian and Jim are part of within Morgan Stanley. So my role is to work with all of the teams on their any questions they might have involving asset allocation, involving some of the things that Jim just talked about. What are the views of the firm, and so I work with the Greystone teams, but I also tie into our central investment research team, which I'll talk about a lot here. So I've been at the firm for about 5 years. Prior to that, I was at Johnson & Johnson in New Brunswick, New Jersey, running the pension fund there. So I've got some experience on your side of the desk as well, reviewing the plans and making those decisions also. So I want to spend just a few minutes talking through the slides that you have in this separate handout. And what I want to do is talk about all of the things that are behind. Oh, do you not have it? Here we go. So clearly you know these two guys pretty well. You know what their capabilities are. They're part of the Greystone organization within Morgan Stanley, which services institutional clients. My role is to work with all those teams and work with our internal investment research team to kind of make sure we're presenting the best ideas of the firm to our institutional clients across the board. We have, as Jim alluded to, a group called the Global Investment Committee. And these are 7 people who really do nothing all day except look at the markets. So they develop our long-term strategic views, 30 years. What do we think the stock market is going to do over the next 30 years? What do we think it's going to do over the next 10 years? And what do we think it's going to do over the next 3 years? And we also produce a lot of tactical views. Now, those don't always come into play with our institutional clients like yourselves, but as Jim alluded to, sometimes they do. Sometimes we may see a market dislocation that we want to take advantage of within the portfolio, and to the extent that we can, we do that for our institutional clients as well. We have developed a lot of internal tools that aren't available to others in the industry. I'll talk about a couple of them here today, but just wanted to give you the sense of what's behind it. And on the next slide, we talk about everything we have both at Morgan Stanley & Co., which has research analysts dedicated to individual stocks, individual holdings that we can bring to bear to the portfolio, as well as 120 analysts, or now more than 120, who are dedicated just to our wealth management clients. So not only our retail clients, but also institutional clients like yourselves. We have a team of almost 50 people who do nothing but look at individual investment managers all day long. That's the only thing they do. So every investment manager that Jim or Brian bring into your portfolio and recommend to you has been thoroughly vetted by this team, and we have research that I'll talk about a little bit more as we go along. But all of these things are available for you via Jim and Brian and the team. So they use their interpretation of what is best for your portfolio with all of these tools behind them to help them make those decisions. On the next slide, so I talked about the one of the tools I wanted to talk about was we call our active versus passive optimization. So our Global Investment Committee has spent a lot of time looking at when we want to be invested in what we call active management, which is managers who are different from the index, different from the market, making bets and making trades that are different from where the market is positioned, versus just simply buying the market, which is usually cheaper. The fees are usually lower, and sometimes can perform a little better. What we found is that no one approach works best all the time. So we have a series of factors that we look at here. I'm not going to walk through them piece by piece, but what you can see is we have a lot of thought behind this. And we look at different areas of the market, large U.S. stocks, small U.S. stocks, international stocks, fixed income. Where do we want to be more active? Where do we want to be taking more risk and taking more bets relative to the market? And where do we want to be tied more closely to the market? And a lot of it depends on what the market environment is at the time. And so these are all things that again, Jim and Brian can bring to your portfolio based on the research behind it that this team is doing all the time. So they produce a model every single month. I don't think Jim and Brian are going to be making changes to your portfolio every single month, but at a given time they may say, okay, here's where the model looks right now, and over the next 3 to 5 years, we think we might be better positioned to be more active in large cap stocks. We might be more active in small cap stocks, or vice versa, depending on where we see the market at a given point in time. On the next slide, talking specifically about our manager selection, as I mentioned, we have 45, the number is 50 now, analysts who are dedicated specifically to investment manager analysis. That's all they do. We have 1,300 strategies that are under coverage, and each of those strategies has a report written on it that's available for you to see should you ever want to. And what I like about the research that we do is not only do we say, here's what we like about this manager, here's why we would recommend this to a given client, but also in that report it talks about, and in our work it talks about, here's what might make us change our mind. And it forces us to kind of be honest with ourselves and tie back to that. So if we say, look, if this person leaves, they're really key to this process. If this person leaves, we're going to reevaluate our recommendation. We may change our recommendation. And it makes us be honest to that. If that person leaves, we have to go back and reevaluate that recommendation because things might have changed. The new manager might not be as skilled, might not have as much relevant experience in that asset class as the manager that we originally recommended to you. So when you see those kind of changes and recommendations coming from the team, there's a lot behind it that went into where that recommendation is made. On the next slide, we talk about the different, what we call the different levels of conviction that we have behind our traditional manager analysis. So what we call the approved list is that 1,300, or a big chunk of that 1,300, is about 800 of those names. That focuses on, these are managers that meet our criteria, that represents a broad range of asset classes for us to choose from. Within that 1,300, a smaller number, about 400 or so, is what we call the focus list. And these are the managers in which we have the highest degree of conviction across the board. The teams are the most experienced. We feel very strongly about their ability to consistently outperform as they have in the past. So predominantly, we'll recommend managers from the focus list, but there are situations in which we'll use managers from the approved list if there are certain areas of the market we want to gain access to, for example, where there might not be a focus list manager available, or there might be a vehicle we want to access or something like that. So it gives us the ability to bring those managers in which we have the highest level of conviction into your portfolio. The last thing I'll say here is because of the scale, because of who we are, on the previous slide we talked about having $800 billion under management. It allows us to negotiate really well on the fee front with our investment managers. For many of the investment managers we contract with and bring to your portfolio, we have what we call most favored nations clauses in place with those managers, meaning they can't charge any institutional client less than they're charging you. Not only recommended by Morgan Stanley, but recommended by anybody. So for many managers, the managers, the portfolio we're recommending to you will have the lowest fee available across the market. And we have that with many of the investment managers that we work with, and it's the advantage of our scale because we can put so much in assets to work, not just in your portfolio, but among all of our institutional and our retail clients. Another tool on the next slide I want to touch on is what we call our adverse active alpha rating. And this is pretty interesting, I think. This is a patented process that we have developed, a quantitative score we developed for investment managers. And what it does is it looks at two different dimensions primarily of what an investment manager might do. So the adverse part means we're looking at managers who have performed well during difficult market environments, specifically difficult market environments for active management. As I said, sometimes active management does really well and sometimes it doesn't. We want to find those active managers who have done well in bad times. We want to combine that with managers who are active, managers whose portfolios are positioned differently from the benchmark. So if we're going to pay a manager for active management, we want them to be truly active management. The combination of those two things we found has been pretty powerful in adding value over and above what the market provides. And as you see on this slide, over time, since the inception of this measure and over the longer term, we've added value both on those managers who are on our focus list and who are on our approved list. So we got this patented in 2014. It's a proprietary measure that only we use, and we've also expanded starting in 2016, I guess, to fixed income managers as well. So we now have it applied really across the asset class spectrum to every manager that we recommend. So all 1,300 of those managers are rated on this measure, and we isolate those who rank highly versus those that don't as an additional screen for us to use when we are building out your portfolio. I'm not going to spend a lot of time on our alternatives due diligence platform. The benefit here is we have, again, great scale, and we have teams who are dedicated to investment manager research and operational due diligence. I'll mention the operational due diligence because we've started to bring it to bear in our traditional managers as well, particularly in the area of cybersecurity. So we're going through a very big review of all of the investment managers we work with and recommend to our clients on the cybersecurity front. How well do you safeguard our clients' data? We're going through this big review with those managers right now. And managers who don't score well on that, we're either going to go back to them and say, okay, you've got to improve your operations in this, and this area, or we're not going to recommend you anymore to our clients. Because we've seen in the industry, we've seen client data get accessed via the investment managers. So it's a big area of focus for our firm. We've spent a couple $100 million on cybersecurity, both at our firm and for our clients' portfolios. And we've hired a couple of folks from the NSA who are now our heads of cybersecurity, as well as somebody who is a member of the Obama White House, their head of counterterrorism on the cyber side. I've seen this woman speak. Her name's Rachel Wilson. It's frankly a terrifying presentation to hear talk about all the things that, all the ways that people can access your data that you don't even think about. So it's.
I'm sorry to interrupt you, but
Yeah.
at some point, I think I would love to have her speak to you. She was the most senior person under the Obama administration, and she spent every day on counterintelligence, protecting, safeguarding government data, and her stories about working with North Korea and the Chinese and how they're trying to penetrate our federal banks. It is fascinating conversation.
It is. Yeah.
And she's a fantastic speaker as well. So.
Yeah, even the granular level of detail, like threats you don't even think about. So one of the things she said is, don't ever charge your phone at a public charging cord somewhere, because hackers can get into that hardware, install things on it, and access your phone's data through there.
Never, ever.
So I immediately called my wife after she was done, said we got to change some things about how we use our phones. It was very interesting.
I know we're digressing, but it's interesting to talk about it. And one of the things, I asked her a question about, well, what are some of the basic things? I'm really not that worried day to day about North Korea and my phone, but what could we be doing better? And she said, step away from checks. She said, a check goes through 7 hands before it clears. And so if you could step away from using checks, you'll be much better off. Because guess what's on the bottom of that check? A routing number.
Routing number.
Kind of interesting thing to think about. Capital One Financial is one of the largest credit card operators in the world. And she said that about a third of the applications to Capital One Financial are to commit fraud. A third.
Yeah, I got a big fraud.
They're opening up credit cards because it's somehow, some way tied to fraud. So, anyway, we'll have a discussion about that at another meeting. But it's just fascinating. We thought we'd share some of the tidbits about charging your phone and checks with you. Maybe that'll change your behavior and
some constructive.
certainly
tips.
change mine.
Yeah, so those are some examples of the tools that we bring to bear, both kind of at a broad firm perspective and individually, and in the managers that we recommend for your portfolio as we build it out. And it's the advantages of the scale, I think, that Morgan Stanley brings, and all of the resources that are behind the qualified team that you see from quarter to quarter here in front of you. The last slide just shows some of the numbers, and of course we wouldn't put it in here if the numbers weren't good. So we have the hedge fund performance, which I know doesn't really apply very much to this plan, but also on the right we show the return of our high conviction lists versus their benchmark over longer periods of time. And you can see that we've added value relative to both the passive benchmarks and what has been a period over the last 5 years of actually really strong benchmark management. The market has really gone up, which makes it harder for active managers to outperform. And even during that time, our lists, our manager selection has done very well. That's all I had. Any questions for me about the firm? I can answer anything related to Morgan Stanley, Greystone at a broad level, if you have any questions on that.
On the slide that's about the adverse active alpha, it says outperformance of the adverse active. I don't understand the scales here. Is it? Okay, I understand it's years.
Right.
But it just seems to run longer than.
So what we're looking at is, so we have the approved list managers, which is we have that 1,300 manager list of strategies that we're covering, right?
Right.
So the approved list is the bulk of that. That's 800 strategies. And what we're looking at there is the numbers, and it's in the very fine print, so I apologize for that, but the numbers you see are in basis points on average how those managers who score well on this rating have done. So if you look at, let's just say, compare the 5-year number for both. So the approved list managers have actually done a little better over the last 5 years, which is interesting. But the approved list managers have outperformed let me just rephrase it a little bit. The approved list managers who score highly on our adverse active alpha rating, what we call our AAA rating, those managers have outperformed their benchmark
51.
on average by 51 basis points, about 0.5% after fees over that 5 years. Whereas the focus list managers have done about the same, 47 basis points, just slightly less than 0.5%. So that's what those numbers refer to. You can see over the last year, active management struggled across the board, and a lot of our AAA managers struggled as well. But over the long term, selecting managers, just those managers that have done highly, and I think the cutoff here is those in the top 20% by the AAA rating. So these are the truly high AAA managers and how they've done over time.
Okay. I mean, but it doesn't really seem like that much of a difference between them in terms of the, 53 versus 49 on the focus list?
Right. You're absolutely right. I mean, what this shows is that just looking at this measure alone can add value over a period of time, regardless of whether you're an approved list manager or a focus list manager. So this looks at all 1,300 strategies that we've approved and made available to our clients. And so anything that scores highly on this rating has done well over a long period of time, outperforming the benchmark by, about, it looks like, the 3 to 5 years, or 5 years to inception, you're looking at about 0.5% of outperformance that's just attributable to this measure. And you're right, there isn't a lot of difference between approved and focused. If you look at the overall performance of all managers on approved and focused, the gap's a little bit different. I don't have that data in here, but we look at that over time as well, and what we see is that focus list managers do outperform approved list managers over time.
This is one quantitative measure, and then we overlay sort of our qualitative assessments of the managers. What are they trying to do? What's their competitive advantage? Is it sustainable? Once you add in all the things that we look at, I think the expectations would be that it would be higher than 50 basis points net of fees.
So that's exactly right. We wouldn't recommend anyone just select based only on this, but this is a tool that we have available to our consultants to choose from when they're working with the client's portfolio.
Jeff, maybe you can also speak to the firm's discretionary versus non-discretionary capabilities. The committee here is evaluating the merits of both. Mm-hmm. And currently we're under a non-discretionary mandate. So maybe you could just share with them how that works and what our capability set is on the opposite side.
Sure. So we have an entire team at the firm dedicated to what we call outsourced CIO. So that's discretionary at the firm level, outsourced chief investment officer. It's a team of about 15 people. And what happens there is that our clients who are interested in that essentially turn the investment management decision-making over to us as a firm. And that central team then makes the investment decisions. You would still work with the team on a daily basis, on a quarterly basis to have the meetings, but the investment decisions would be made by that central team. There's kind of an interim step that's available to our Greystone consultants, just given their level of investment sophistication, which is that we allow the teams to make that decision, and then a committee of people that I'm on and a lot of these OCIO folks are on as well, evaluates and reviews those decisions before they're made. So they would submit the decision to say we want to make a move within, between Schaefer Cullen and the S&P 500, for example. We'd look at the IPS of the client and look at the managers and the move they want to make, and we'd say yes, we approve, or no, we have some more questions for you on that. So we, in addition to kind of a traditional advisory relationship, which you have right now, we can offer discretionary management in a couple of different flavors where our firm is actually making the investment decisions. The fiduciary status is the same. We're acting as an investment fiduciary in both cases, but it takes one kind of decision, away from you where you don't have to think about it, right? We can say, okay, we're letting you make those investment decisions based on what you know of the goals and objectives of our plan, and we review them with our clients as much or as little as they want. We have some clients who don't ever want to be involved in that, and they just want to kind of hear after the fact. And we have some clients who say, before you make a move, just let us know what you're going to do, and we work with them that way. So we have a lot of different ways, and of course it can be customized to however you would like to work with us.
And as you think about what the right model is for you, even if ultimately you decide to go down the discretionary path, one thing we will not do for you is to decide how much should be in stocks and bonds. You need to own that decision. And we would provide recommendation and advice, but once you develop those targets and ranges around those targets and codify that in the investment policy statement, which we have done, we can then operate within those ranges. But to say to you that we're going to put 38% of your portfolio in U.S. stocks without you weighing in on that decision is not a decision that you should delegate to somebody else.
Right, that's exactly right. So all of our relationships on the discretionary side are based on our client's investment policy statement.
That's right.
So it's an investment policy worked out between us and our client, and then we manage the portfolio based on those parameters.
Okay, great.
So Brian and I appreciate the trust and confidence that you all place in us. We're very respectful of that. But as we said a couple of meetings ago, we think it's also important for you to see the resources and tools that we draw from. So it gives you continued confidence in us in terms of how we make recommendations and how we construct the portfolio and when we make decisions on your behalf. So I'd like to thank Jeff for coming from New York to spend time with you all today, and hopefully you found that beneficial. What we'd like to do is continue to share the resources that we use to make it easier for you to understand how we're deciding what managers, asset allocation, et cetera, we're using for the benefit of Portsmouth. And I hope today you took away a couple things. One is, because we have the resources, almost 50 analysts doing manager search and diligence on behalf of our clients, that frees up us to make portfolio decisions for our clients. Really, really important distinction. We have a lot of competitors in the marketplace who we compete with, but a lot of those firms are doing both manager search and diligence, the same people that are providing the advice to you. And we separate those two because the last recommendation we made, if we're doing manager search and diligence, we just absolutely wouldn't have the time to look at the portfolio and make the strategic decision that we did, good or bad. I think the second point I'd like to highlight is this is something else that gets overlooked. But again, it relates to our competitive advantage, and that is the fee compression. So as Jeff said, we have what is known as the most favored nation status with almost all the outside managers we work with. So if a competitor is accessing a manager at 1%, but we know the lowest fee available to any institutional client is 0.5%, we are going to get that 0.5% for you. So that manager fee is really important over time. It makes a big difference in the long-term results of the portfolio. So we fight for you behind the scenes using the heft of Morgan Stanley to make sure that we're getting the best pricing possible for you. So that extra 0.5% in my example accrues to Portsmouth over time. And that's across the entire portfolio. So you have to keep that in mind. Are you getting the best manager pricing? So yes, we think we've got sort of state-of-the-art risk tools, asset allocation, manager search, but are you getting the best pricing? And we think that is a big competitive advantage for us to make sure you get that competitive pricing, because we demand it from the managers we work with.
You come back to this book now.
Okay.
Makes sense. But, thanks, Jeff, again, for your comments. I'm going to step through the portfolio and come back to a lot of the things Jim talked about, and Jeff as well, as we kind of evaluate the results for the first quarter. But on page 36, just a quick snapshot at asset allocation. As Gail talked about earlier, I think you're probably looking at April or maybe May numbers. Finished the first quarter at around $220 million, $220.2 million. You can see above that how those assets are allocated. The last two columns I think are important to take a look at. The second from the right is the target allocation. So this is that decision that you don't want to delegate that I mentioned off of Jeff's comments. As you're aware, a year and change ago, we took a comprehensive review of the investment program and made some fairly significant changes in the way we were allocating our assets. Jim's comments, he talked about moving $42 million out of U.S. equities and into non-U.S. equities, and that's reflected in these numbers here. That's a process we undertook. We started implementing in July of last year and fully implemented at the end of the third quarter. That's been a terrific place to be. So again, based on those outlooks and the capital market research that Jim and I are leveraging off of Morgan Stanley, we're able to move the portfolio in the direction of the opportunities as we see in the future. It also reflects the numbers here above also reflect the $11 million that we moved, the additional $11 million we moved out of Schaefer Cohen into the Vanguard Institutional Index Fund. Again, that was a terrific timing because the index has done better than the Schaefer Cohen portfolio since we moved those assets by the tune of about 1%. So our timing has been really good. But the important thing I think to point out here is where we were in terms of our allocations at the end of the first quarter is pretty much right in line with where our targets are. That's an important risk control metric that you should be looking at and that you should be evaluating us upon. You can see we're slightly overweight U.S. stocks, slightly underweight bonds, but by and large, we're right on the targets. We're right where we said we would be. The next slide on page 37 takes a look at total fund performance, and we show some negative numbers in the first quarter. As Jim talked about, capital markets both in the U.S. on the equity side and developed markets overseas on the equity side were down during the first quarter as volatility came back into the markets. And fixed income returns were negative as well as interest rates were going up as well. So it's not surprising to see a total fund result that's down a little less than 1%. But importantly, it's outperforming two benchmarks. I want to call your attention down to the bottom two rows there in this table on page 37. This policy portfolio. So this is a passive representation of what we would have earned if we were constantly at the target allocations that I showed on the prior slide. So if we were 38% in U.S. stocks and we earned the U.S. stock market's return, if we were 32% in non-U.S. stocks and we earned the non-U.S. equity market return, we roll up all those numbers into a single number, what would that have done? It would have been a little bit worse than what we did. So we were able to protect a little bit of capital in an environment where equity markets were down. The manager benchmark number is if we took the individual managers that we have in the program and the benchmarks we measure those individual managers against, what would that have looked like? And this is another metric where we were able to outperform in the first quarter and quite frankly over the longer period as well. Now, what is the primary difference between those two numbers, this policy portfolio and this manager benchmark number? So when we talk about results, the primary difference is with respect to the Schaefer Cohen portfolio. So Schaefer Cohen is a very defensive equity manager. And they've been in place for a long time. And you'll recall prior to 2013, the financial circumstances of the plan, and this manager came in place in a time when the financial circumstances were very different for the plan, and it made sense to be more conservative. Since that time, in the pension obligation bond issuance and the better funding of the plan, we've been able to take more risk. And those are the recommendations and the direction we've been moving in since we became more involved, a little less than a year ago. But that's the primary difference between the two. That's why we're showing underperformance relative to the policy portfolio over long periods of time, because Schaefer Cohen used to run 40% of the overall fund, and it was very defensive in nature when equity markets were soaring, particularly last year. And then when we make that adjustment, that's why we see the excess returns that the total fund's been able to generate relative to the manager benchmark returns. We think it's important to look at both. Quite honestly, we're trying to beat this policy portfolio, and so we're moving in the direction to be able to do that. This quarter, it's really the second quarter since the new program's been fully implemented. We've been able to do that. We underperformed in the fourth quarter of last year. But that's our primary bogey. That's what we're trying to beat. So what was going on in the first quarter in the portfolio? We lost about 0.9%. As Jim talked about, global equity markets were down more than 1%. It was the worst quarter that equity markets turned in the last 8 years. And if you just looked at that single number, it really masked what was going on. As Jim talked about, January was through the roof, and was really since January 25th, I think, was the peak of the market. We saw some pretty weak results in February and then following into March. So you look at that one number, it sort of masks what was really going on. During the quarter, Schaefer-Cullen underperformed, which was disappointing for us because the equity markets were weak. When you have a defensive equity manager, you would hope they would hold up better in a weak market. They didn't. We'll talk about why they didn't. Our emerging market manager, Artisan, also lagged during the quarter, but we had some really, really strong results from Rice Hall James, which is a small and mid-cap growth-oriented manager in the U.S. We'll talk about that in a minute. And the American Funds Euro-Pacific Growth Fund. So this is a non-U.S., largely developed non-U.S. equity manager. Both of those portfolios more than offset the underperformance from the other two managers. The other factor that was working well in our favor is the way we put the fixed income portfolio together. As Jim talked about, interest rates were going up during the first quarter, and they continue to do so here in the second quarter. We've consciously structured that portfolio to invest more in shorter maturity bonds than the overall market. So as interest rates go up and bond prices go down, our portfolio is going down substantially less. And we'll talk more about that in a minute. On page 38, just a couple of different charts. This on the top left-hand side is something we call the ratio of cumulative wealth. This blue squiggly line is basically the performance of the total fund relative to that policy portfolio. Where that line is downward sloping, it means we're underperforming, and where it starts to turn up, that's indicative of periods of outperformance. You could see in the first quarter of this year, you see that slight uptick. We hope that's the start of a trend going up. Right next to that is looks at performance on a risk-adjusted basis over the last 5 years. So the total funds return generally lagged that policy portfolio over the last 5 years, but did so with less volatility. So similar results, slightly underperforming on a risk-adjusted basis. And again, keep in mind, we have 2 full quarters of a new investment program. So we expect the changes we made are going to result not only in better performance relative to this benchmark, but on a risk-adjusted basis as well. On the left-hand side, just a quarter by quarter, on the bottom there, a quarter by quarter relative performance of the fund. You can see some quarters are up, some quarters are down, but over that entire period we're underperforming. And then on the right-hand side, how are we performing relative to the performance of other public funds? It's important to keep in mind that asset allocation differences among different plans are going to drive almost all of the difference in performance. So the fact that we have more in some asset class versus another public fund is going to drive the relative difference in return from other public funds. Nonetheless, we think it's important to look at, and plans are always curious about how they stack up relative to others. The results are improving here, and we would expect those to continue to improve based on the changes we've made. On page 39 and 40, the individual manager performance, and I'm not going to walk through all the numbers. I'm going to touch on a few of the managers here, but certainly happy to answer any questions you might have. I mentioned Schaefer-Cullen turned in a disappointing quarter there. You could see they were down 4% versus their own benchmark, which is the CBOE Buy Right Index, which was down 1.6%. So in general, what we would have hoped is this defensive equity manager would have held up better when equity markets are weak. And I think the first quarter, we talked about the difference in January and February. It was actually more striking when you talked about the kinds of stocks that Schaefer Cullen invests in than the broad market. So Schaefer Cullen actually outperformed in January. They were up 1.8 versus 1%. They actually outperformed in March, which was they were down 0.3%. Their index was down over 1%. So all of their underperformance is concentrated in the month of February. They were down 6%. Their benchmark was down 1.4%. Generally speaking, when you see equity markets as weak as they were in February, it's the defensive names that hold up. That didn't happen in February. In fact, the defensive stocks got hit harder than a lot of the higher priced names. So it was an interesting period. Although equity markets were weak, it was the defensive stocks that did worse than some of the other stocks. So that really explains all of their underperformance. We still think it was a good idea to move $11 million out of them to capture the subsequent rebound that we were expecting to see in the U.S. equity market. And as I mentioned earlier, that's added about a % of value to the plan. The Vanguard Institutional Index Fund, this is a passive investment designed to track the performance of the S&P 500. You could see it did that. Goldman Sachs is our small cap value manager. You can see they've done well over time. They were down 2% during the quarter, which is a little bit better than the Russell 2000 Value Index. And you can see over a longer period of time, their margin or their performance exceeded that benchmark over time. This has been a long-standing manager for the plan. You've had them for a number of years, and they've done well for us. I'll say the next one, spend a little bit of time on this one, Rice Hall James. This has been an absolute home run for us. It's been, you might recall, we used to have another value-oriented manager, Hotchkiss & Wiley. Mm-hmm. And one of the comments we made to the board was, we've got a lot of value exposure. Let's get some growth stocks in this portfolio. And that's why we hired Rice Hall James. They were up 6%, over 6%. This is after the fees we pay them. And their benchmark, the Russell 2500 Growth Index, was up 2.5%. If we looked at the inception period from when we've had them, and our inception goes back to October 1st of last year, this portfolio is up 18.5%, and their benchmark's up less than 11.5%, so 700 basis points of return. And I think one of the more interesting or telling things, if you could just flip back to page 36, and you look at the amount of money we have with Goldman Sachs and Rice Hall James. Goldman Sachs is $8.7 million. Rice Hall James starts at has $10.7 million. We started, those two portfolios started with the same dollar amount on October 1st of 2017. That gives you a sense as to the magnitude of some of the changes we've made. It's been a terrific investment for us. They've had some enormous gains in some biotech names and information technology. Been a terrific place to be in this portfolio, and we've been able to capture those results. Euro-Pacific Growth Fund here, I mentioned in my comments about total fund results, is another portfolio that's generated significant excess returns. We were up 1% in this portfolio. If you go down a couple of rows, this MSCI All Country World ex-US Index, it was down 1.2%. So over 2 percentage points of excess returns from this portfolio. They've had a lot of money invested in technology stocks, picked some really good names in that space. And they have about 30% of their portfolio in emerging markets as well. And as Jim walked through results, you might recall emerging markets were up about 1.5% during the first quarter. So all of those different decisions that the manager has made worked particularly well during the first quarter. You can see over the longer run, again, this has been a long-standing client manager we've had in place, excess returns being generated there. Not a lot to say about Lazard. They're a relatively new manager. Their performance was in line with the benchmark. This is a concentrated manager. They hold about 30 stocks in their portfolio. So it wouldn't surprise me to see wide swings relative to the benchmark in terms of outperformance or sometimes underperformance in individual quarters, but we expect over a long period of time that this manager is going to generate some nice levels of return for us. I want to spend a minute on the last two rows there. This is our emerging market manager, the Artisan Developing Market Fund. We show that relative to the emerging market index there. Little less than a percentage point of underperformance. Now, this is an interesting portfolio because they buy stocks that are have a lot of their revenue that comes from selling their product or services into emerging economies. And they don't so much care about where that country is domiciled. So I'll give you an example. 20% of their portfolio is actually in developed market companies. And that actually explains a lot of their underperformance. Developed markets were pretty weak in general during the first quarter, even though emerging markets were up 1.5%. So having a good chunk of that portfolio in developed markets was a drag on performance. One of the names they own in their portfolio is Facebook. Well, we all know Facebook. It's a US company here, but they're generating a lot of their revenue, and a lot of their user base is coming from these developing countries. So there's a number of examples like that where these companies are actually traded on either a US exchange or Germany or the UK or France, developed market countries, and those stocks are going to oftentimes reflect what's going on in the countries in which they're domiciled. So we're not at all concerned about the level of underperformance here. Again, over a long period of time, this is one of the new managers we put in place. They had a really strong end to last year in terms of the absolute returns that they've been generating. So we still have a lot of confidence in that manager. Last thing I really want to talk about is on page 40, the top of page 40. The first three managers there are our U.S. fixed income managers. The benchmark under there, the bar cap aggregate index, is this index that Jim referenced earlier, which was down 1.5% as interest rates increased. So BlackRock is, by the way, BlackRock is one of these managers that we have most favored nation fees with. You're paying them 15 basis points. If you were to go directly with them, you'd probably be paying 40. They were down in line with the market. They construct their portfolio that looks an awful lot like what the index looks like. They're still making investment decisions relative to that, but in terms of their maturity profile, it looks very similar to the maturity profile of the index. And we think that that's an important allocation to have because while we think interest rates are going up, we've thought interest rates are going up for years and years and years, and of course they continue to go lower. We think we're in that period now where we're likely having sustained rates, but BlackRock serves as that hedge for us if we're actually wrong on rising interest rates. The other two managers have much, much shorter maturity profiles in their portfolio. And you could see they went down substantially less. We've got basically the same amount of money invested in all three of those, and if you add all those three together and take the average, we were down about 0.75%. So we went down half as much as the benchmark during the quarter. And that was a conscious decision. We thought interest rates were going up. We had an expectation that interest rates are going up. It has in fact happened. And so we wanted to consciously create a portfolio that was going to do better if that environment would materialize. And we've done that. We've done that in the first quarter of this year. For the 1 year period, the combination of those three managers was up about 1% for the last year. Interest rates have been relatively stable. So even if interest rates are stable or going down, we're going to keep up with with the fixed income markets in general. But where this portfolio is really going to shine is when interest rates go up, and that's what we've seen. I'm sorry, I think you had a question.
What are unconstrained bonds?
Well, that's a good question, because it's supposed to say unconstrained
Well,
bonds.
then I would understand it, so that's why I was asking if that was a new word to me.
Well,
Okay.
we like to make
Now
up
I
our
know.
own
It
is as
words
of today.
sometimes. So this is a manager that can go anywhere in the global fixed income markets to find
Yeah,
opportunities.
unconstrained, I
Unconstrained.
get, but
The other thing I'll point out, and I didn't really include this in my comments about fixed income, so the next one down is this Templeton Global Bond Portfolio. They have some investments in the U.S., but they have a lot of investments overseas. And the way they've constructed their portfolio is they can actually make money in an environment where interest rates in the U.S. are rising. Again, that's a really important part of the overall strategy that we have in place, and you can see that they've done that.
How do they do that?
So
I may ask, I'm sorry.
they
Question.
they are short U.S. interest rates. So what that means is they go out and borrow Treasury securities from somebody, and they sell them in the marketplace. And what they do over time, as the price of those securities that they sold short go down, they'll go out and buy them back. And those securities will go down in price when interest rates in the U.S. go up. So it's a strategy that you oftentimes hear about short selling in the context of hedge funds.
Yes.
But this is something in a SEC-registered mutual fund that they're doing to capitalize on their outlook for U.S. interest rates. One of the things we'd like to do, if we're still fortunate to be working with you, is to reevaluate the fixed income structure. We think it's been a terrific place to be. We think there are some other opportunities given what's gone on in the fixed income markets, and quite frankly on the equity side too, that we can talk about and make some recommendations around to again continue to get a bit defensive as interest rates are expected to continue to rise. I think we're pretty well positioned for that, but there are some segments of the market that were hit particularly hard in the first quarter of 2018 that are now starting to look attractive. And you know, we'd love the opportunity to talk to the investment committee to vet some of those ideas in the future. So with that, I'll leave it at that. There's some other results down here, nothing really of note, and be happy to answer any questions that anybody has. There's a lot of, I see you turned to that. There's a lot of additional information back here. In the interest of time, I know we've taken up a lot of your time, but you know, we're happy to walk through it if there are any questions, or if anybody has questions after the meeting, I'm happy to chat as well.
all right, thank you very much. Are we ready to leave the talk?
Yep. Good.
All right.
Thank you very much. Well, thanks again. Good morning again, everybody. Happy to be here. It's always a pleasure to come down and see you all. And as always, we certainly appreciate the partnership and the long-term relationship that we've had. So I'll talk to a couple of items that are in this review book. As you know, or for those that were here the last meeting I attended in March, I went through more of a more comprehensive overview of the services that we provide, especially in light of some of the new additions to the board. One of the conversations also talked about during last quarter's meeting were some of the impacts that our call center was having on service and wait times and handle times, directly as a result, primarily with enhanced security implementation that we had put in place and some of the impacts on that. I shared some information after the meeting a video link and some additional details on our security provisions. But I did mention I would talk a little bit more in detail today about how we are kind of trying to fight the cyber, attacks that are occurring. So good segues from earlier. A couple of things just also to comment on is we are in conversations to schedule some retiree meetings. So hopefully those are coming up shortly. We have a call on Monday and hope to finalize some details around that so that we'll have some representatives down here and offer the opportunity to meet with individuals. Again, most of the system is in pay and receiving benefits, but if they do have questions, whether, regard of what our services are, issues on the payments they get, or if we can further help them, we'll talk through that. Some other current event items, and then if I know there's only a handful of actives, but if any of the actives want to attend to, we can, show them some of the resources on the website and how they can go out and model benefits and, be prepared to start for when they're ready to make that decision. So more details to come on that. The second thing I'd like to mention, especially with the new CFO coming on board, about a year and a half ago, we held a fiduciary training session for the board. Again, there's been some new members to the group that have come in, so I think it makes sense for us to come back and to hold another one of those sessions, probably in the second half of the year. We can talk about what timing would make the most sense for that. And I'd like to do it. Last year, I think we ended up doing it over the phone.
Yes.
It'd be better to have someone here in person, and we can certainly do that. So I guess one of the things for you all to think about is, how you might want to handle that from a timing perspective. We could do it. One of the considerations is, I know generally when there's quarterly investment review session, the meeting there's a lot of time focused on that. It wouldn't make sense to then add the fiduciary training on top of that, unless you wanted to have a longer meeting for 1 month of the quarter. Or we could also think about maybe including it when Andre comes down for the annual valuation review. We generally do that in October. So we could, we do that in November. November? November.
November's a investment update.
Okay,
So I
then
think
it's
we do it in
October.
October.
Yes, yeah, you're
I'm
right.
sure it's October.
So we could do it as part of that. Again, or if you wanted to hold a special session, again, completely up to you all, but maybe something for you to discuss, and we can think about when to schedule that. All right, and most likely it would again be Mark Niziak, who is one of our head ERISA consultants that was with our organization, and he did that overview a year and a half ago. All right.
So when would our next investment update? Would that be September or
August.
August. Okay.
And I know there's some turnover on the board in September, so.
Oh, there is.
October may end up being, but we can put that on the agenda and have that up for discussion when we have more of the board present.
Yeah, I think October might work well. I know generally Andre can go through the overview of the valuation in 45 minutes or so, and if we then, if you don't have a lot of other monthly business, and I know that may be sometimes hard to project, but let us know. The more time, obviously notice for me, I can make sure I lock in Mark in his schedule. All right. Okay, so let me spend in tab 1 here just some additional overview on the data security information. So, as I mentioned, I think last time I was here, Tony Tedisco, he's our Vice President of Information Technology. He's the one who recorded that video. If you didn't see it, I'm happy to recirculate it again if anyone has interest. It kind of gives an overview of some of the information I'll share here. We did hire earlier this year an individual, Tom Shola, who is an AVP just on data security for the RPS group. So he's new to the organization from one of the largest New England regional banks, and has a history of working on data protection, and is working very closely with us now on the things that we're doing. So I won't. I am not an information IT, tech wizard. So I won't go into specifics here. If you do have some follow-up questions or areas of interest, I'm happy to get somebody to talk more to that or get more information on it. But what I want you to know and what I talked about last quarter, and I think as an important follow-up, I think the banking industry obviously started to see a lot of these attacks, and from a financial institution perspective, and trying to get at data a few years back, and then a shift started to occur where retirement providers were starting to see that, and that came pretty heavy last year. And one of the things from our perspective is where we had a lot of security in place, we quickly realized, with that shift in focus by a lot of these fraudsters, that we needed to put a lot of additional enhancements in place as quickly as possible. We have not lost data, so there was no issues from that standpoint. But by putting in a lot of these additional protective measures, that's what drove a lot of that increased call time for our phone center. And since that was ahead of our plan, it impacted some of the service standards like I had talked about. We're very confident. We feel that's been resolved. We actually just brought on board an additional 35 representatives to the phone center. We've had really, really good results over the last 45 days or so. I won't go as far as saying that all of our issues are solved because it's been a short time period, but we'll continue to monitor that. And I think from a forecasting standpoint, now that we know what's needed from that aspect of it, we're able to factor that more into what we're doing. Have you all heard any additional comments on individuals contacting us, or?
I have not had any complaints about call time.
Okay, great. All right, so on page 6, so what I show here is just kind of a high-level overview of what we refer to as having this scalable platform. And you see this reference to Azure and this cloud image. So we're actually one of the first and only at this point total retirement outsourcing record keeper that has taken their entire platform and put it into the cloud, if you will. So what that means is, from an infrastructure standpoint, it's no longer relying on servers that sit in our location and then have redundancy in other locations at other properties that we deal with. This is a partnership. We're now using Microsoft, and Microsoft has taken our information and has put it into their secure cloud network. So, everyone, I hear the cloud, you kind of think it's all this information is up in the sky. It's not that fancy, but there are sites in the United States that Microsoft manages to level of security that's on par with the national government. Tony Tedisco, who I mentioned earlier, talks about the few times he went out there, being picked up at the airport, being driven to the facility. They don't allow people to come there on their own. There are no-fly zone areas. So they're extremely secure data centers that Microsoft then duplicates in other parts of the U.S. Insofar as they also are starting to put some of this information in secure centers in the ocean. So it's pretty interesting when you think of all the places that these servers and security is being placed, but unfortunately these are the things that are needed. So it's a significant investment, but we know you trust us with your individual's data, and we need to take those steps for whatever's necessary. So on page 7, we kind of look at more of this multi-tiered approach and how we keep participant data secure. 4 things here. The multi-tiered approach really reflects how our organization is structured and how each different group deals with this issue. So, from the top down, I've talked about how John Hancock is owned by Manulife, which is, a global provider based out of Toronto, Canada. Manulife has full global policies that we need to adhere to. They start the initial lines of defense from a firewall perspective and attempts at getting into manual life-related systems. You move down to John Hancock, the U.S.-based organization, who then controls policy, procedure, vendor management, and those relationships, and ensuring that, we're comfortable with what's in place. And then you get specifically to the Retirement Plan Services Group, and that's where we focus on all the applications that are used for record-keeping services and participant access. And that's where you get more into the actual what is being done for participants to come into the website or to call us and be authenticated. From a front-end security, that's everything we do up front on the website, and again, the call center, which I'll talk a little bit more about in a second. Infrastructure, that's all that behind the scenes, and this cloud-based system, and procedures and individuals we have in place that are continuously just looking for attempts to get at our data, and that happens constantly. Like any other organization at this point that has any type of participant data, we're constantly under attack, if you will, from individuals and groups trying to get in and trying to get information. And then all the operational safeguards is all around policy and procedure. A lot of icons, a lot of items here in the next 2 pages. I'm only going to highlight a couple. Again, the left-hand side looks at that front-end security. This is the participant-facing, and the right-hand side is on the behind-the-scenes infrastructure and all of the back-end office work that we do. So from a front-end security, you think about, primarily individuals look to come to us in 2 ways, via the web or by calling us. So we have put in additional layers of security measures just for individuals who are initially trying to get information, and then more so when they're trying to make transactions. And this, a lot of the transactional work is really more focused on the defined contribution and the 401k side, since individuals have the ability to take loans, to take distributions. There's much more of an involvement in getting a pension benefit out. So a lot of the transactional things don't come into play quite as much because they're working through you all. They're going through a full validation process. But we've added enhanced IDs, no longer using social security numbers for individuals to come to us. Additional security level questions, asking things like, who's your favorite author? What's your favorite sports team? Not what's your mother's maiden name? More things that hopefully are harder to get at. We just started some of this, what we call knowledge-based authentication. This is from the phone center. We're using a vendor called LexisNexis. And it's the ability for, if someone comes into the call center and they're not able to validate all their information, we can actually ask them questions for things that don't even relate to the retirement plan. So for example, and this is based off all information that is available. For example, we see that you sold a property in 2012. Can you tell me what the address of that property was? We know that you have a sibling. Can you validate their date of birth? So it's really this second, third level type of questioning that for the most part, people are getting more and more used to validating these things, but you can see when it comes to items like that, how it would extend length of calls.
You said that was LexisNexis?
LexisNexis.
Isn't that what you use for, okay, familiar with it.
There are a number of data information services LexisNexis has accumulated over a time period, and there are different versions for different purposes. And one aspect of that literally will give you essentially think of every credit application, everything you've ever filled out, all of that information is assembled, collected and collaborated with public records of every sort and type, including criminal, if that's the case, photos and whatnot. So it does give you a comprehensive way of identifying individuals. It's a little disturbing when you see how much. Yeah. But for this purpose, it does provide quite a bit of assurance. It'd be rather difficult to forge or falsify that level of information.
Yeah, but there are always attempts. The other two I'll mention, you see on the right-hand side of page 8, phone printing and risk-based authentication of the risk engine. So phone printing is also something new we recently added. We also refer to it as pin drop. This is something that's also used by the call center. So what it does is it's technology as an individual calls into the call center that uses over 100 different scoring parameters based on that phone call, and then gives that call a score of whether or not it is believed to be authentic. So, for example, if you have called the call center on a handful of occasions, it's acknowledging what number you're calling from, what type of phone line you're using, mobile, landline, what part of the country your call is coming from, and a number of the background noise aspects, and it takes all that into account the next time someone calls, if it's you or not. And if there are so many different things that don't match up, it's going to flag it, and then it'll lead us on our call center to go into second and third level questioning on making sure that it's actually the individual who
How much of this is voice response before you get to a person?
Yeah, so our call center does come through a voice response, so it does start there, but it start to pick up where that's coming from and starting that scoring system. And then if individuals want to talk to a rep, that's when they come into us. But if the voice response system is also flagging some of these concerns, it's going to send the person directly to a rep. And then the last one here, the risk-based, that's a very similar thing to phone printing, but done via the web. So it looks exactly where the web access is coming from and starting to identify all of this activity. Now, again, a lot of these fraud groups are bouncing signals multiple places across the world, but it will start to recognize patterns and, again, try to flag situations that may be of concern. So it's it's amazing to think of all of what's necessary now to protect information, but there are a lot. There's a lot in place, and we continue to look for more leading technology.
How much do you think all of this is going to drive expenses?
Well, it's a consideration. It's it's something obviously we need to focus a lot on, and it's really forcing us to just look to be efficient in other places. But it is definitely an increased expense that our organization has to take on, and so I think based on our scale, the fact that we have 57,000 clients, we are a global provider. We're able to get good cost for the value we're getting for these services, but definitely a consideration on driving cost.
Wouldn't it maybe long-term down the road be balanced out by potential losses, though, that you might have had if you hadn't put in all the security?
Yeah, hopefully. Thankfully, again, this is a daily occurrence. We've been very, very strong against the defenses so far, but. And then the right-hand side, quite honestly, this is a lot of the back end. This really gets into the technical aspect of what we're doing from an infrastructure, from the cloud-based system, the record-keeping systems, a lot of firewall work, a lot of what this patching is referred to as. These are individuals that watch all of the potential attacks on our system. If they see anything that could be a potential weakness, they immediately patch it and then look to change the code. And then the fraud groups change their code to try to match the code that's been changed. And it's just these things that can constantly go on and on over time. And then we have numerous certifications. SOC 1 is looking at your system organizational controls. There's a SOC 2 that we're in position to also extend to, which is more assurance of a lot of the procedure and control we have in place. Any questions? Any other questions about? Again, if there are questions, needs, requests for additional information, I'm happy to provide that. All right, so I think for the most part, I think I mentioned this the last couple of meetings, we can skip most of the section 2. You all do a very good job reporting transactional cash flow on different periods, and then obviously Greystone is also providing much more detailed return allocation information. I just do include this because it's our standard quarterly report. One thing I will mention is On page 16, for example, we break down actives retirees in terms receiving benefits or termed with vested benefits. Our actives don't match, Gail, what you just mentioned, so I'm just asking Irene to double check and make sure that we're on equal footing, and or perhaps those couple of individuals were updated after this was run. But we'll come back and validate if we think we don't have an exact match there. Page 7 just shows for a cash perspective, again, high-level plan activity for contributions and expenses coming out, and then the quarterly benefit payments that we're sending out. So, on average per month for the supplemental, we're issuing about 366 checks on average of just over $2,000 each in a benefit. And then the fire and police is around just short of $3,000 for an average monthly benefit. I did include some interaction information. We'll look to see if we can include some trending. We have seen increased activity on the internet, so again, a lot of that does go back to individuals becoming more comfortable. Most people, since it's a frozen system, are just coming out to check and confirm if their check has been issued or if they need to change banking information. And then finally, as provided on a quarterly basis is the cost structure. Really no significant changes from everything that's been in place over the past quarter by quarter. Page 30 gives you a summary of expenses for investment management expense, John Hancock services, and then total expense. And then page 31 and 32 look at the quarterly expense and revenue sharing grids that take into account, again, just quickly going left to right as a reminder of how this works. We show total participants or total individuals still in the system. Using Goldman Sachs, average assets for the quarter was $6.7 million. It's 4% of the allocation. The Goldman Sachs expense ratio is 97 basis points, which equals a projected annualized expense of $65,422. Goldman Sachs is one of the few funds that does share revenue, and again, that's money that comes back to the plan to offset costs. They share back 10 basis points, which is part of the 97 basis points. That equals $6,745. If you go down the list, we total all that up at the bottom. So projected, again, based off that quarterly allocation for the first quarter, the weighted average expense, 62 basis points, with a little bit over 2 basis points coming back to offset plan costs. And then the bottom just breaks that out, and again, projecting it out annually. And then those we invoice quarterly, and those are some of the invoices that come through this group for approval.
I had a question on page 24. If the plan went out of existence in 1985, which is like 33 years ago, how do we still have some people in there between the age range? Are they all 49 and 9/10? Because they would have had to have been like 18 or 19.
That, I think, that's something else I actually just noted, and I sent Irene a question. I believe those may be the city council members that at one point were eligible for this.
But most of them are not that young either. That's what I wondered too.
I'm sorry, you're looking at age.
Yeah, I'm looking at active participants by age.
Which page? 16?
24.
24.
Because it's in the fire and police, and don't they go into the general supplemental?
They go into
as opposed to fire and police?
That's correct.
So you're questioning the individuals 40 to 49?
Yeah, why there were so many. I mean, if that
I can check to see who
closed 33 years ago.
they are.
They would have had to been.
I'm one of them.
No. This is fire and police.
It didn't close.
Fire and police didn't close
to
to 94, 95.
95, yeah.
Okay.
Yeah, so that's.
Okay. Sorry.
No, that's.
Yeah, that's right.
Okay.
What I was referring to was an individual. the city council was eligible for a certain period of time for the supplemental plan.
Right.
That's no longer the case.
Right.
My understanding was we had updated the data on those, but one of them may not be updated because there was years of service that looked a lot less.
Yeah, but
Okay.
it's still too many, though. There.
Too many.
Yeah, to be 50 to 59, even under PRS.
So you're going back to on page 16.
Yeah, I'm just thinking.
Yeah. So I will check that number. Well, we'll see exactly who those people are.
Okay.
Maybe.
I'll send you who we have too, if you want. That way we can cross-reference.
Okay. Yeah.
Yep.
Yeah, this is going. It's too young.
I know some of them, like the ones we question, are people that are vested that are no longer here.
Right.
So
Yeah.
they haven't started getting their retirement yet, even though they might have had 6 or 7 years. They're still vested participants. They don't work here any longer, but they've not yet retired.
Right, but they wouldn't be. Oh, I hear what you're saying. But I don't know that.
And I simply wonder, because I know some of my classmates,
Your class?
yeah, class of 1984. But they came to the city like within 6 months of graduation.
Right.
They came right in. So they would have come in at 18. Now that put them a little higher than 50, but that's that same age range. If you came into the city right at 18.
Right.
Yeah, the only detail for years of service and age are the actives. So the termed vested benefits, we're just showing the count. So anywhere where you see the age breakout, so the years of service, it's
Okay.
only for actives. So we'll go back and validate the data and make sure.
Okay. Any other questions? Well, thank you, Tom.
Thank you.
Of course, I was picturing like Tony flying in, and then they had to put a blindfold on him before they got him.
Pretty much. He was pretty excited about the whole experience. So yeah, so it was pretty neat.
All right, is there any other business? So without a quorum, I think we can still call the meeting adjourned.
Certainly.
And thank you all very much for attending and for all your information. We appreciate you coming down and sharing all of that with us.
Thank you. Thank you. Happy to be here.
All righty, have a wonderful rest of May and early June.
Thank you.
You asked me about attorneys and.
Oh, my goodness.